the other thing I was going to ask you is, let me play devil's advocate on this. So if somebody was flipping properties, and instead of being in an S corp, they're in a LLC, how would I know that you said the self-employment tax? How would that look different from a tax perspective?
Yeah. So yeah, that's a really good question. I'd like to model that out using $100,000 example because it keeps the numbers simple around. So let's say we have someone who's fixing and flipping properties, and after all their expenses, they net $100,000, and they're doing this under an LLC. They haven't made any type of election to be any type of corporation. When that tax return is done, they're going to have $100,000 of taxable income. So that's going to hit their federal tax bracket. Let's just assume that comes out to 20%, just as an example. That's a $20,000 tax bill, right? Then employment tax happens on top of that. And remember, that's 15.3%. That's another $15,000. So now we're at $35,000. And, we haven't even talked about whether or not they're in a state like California, Illinois, New York that has a state tax, and a couple of other things that could be levied in there. So by the time they look up, half of their profit could go out the door to taxes, and which is why tax planning is important. So just a simple change in entity structure. Let's juxtapose that with an S corporation. If they had done so under the S corporation, we could have set it up. And again, this is purely as an example. Let's assume their net profit is 100K, right? The S corp requires one of the officers to have a reasonable compensation. That means a W-2 wage. So let's imagine we carve them out at a $40,000 W-2 wage. Okay, they still made $100,000. They just made 40 from a W-2, 60 from their business. So they still made $100,000. They still owe the 20K, but that $15,000, instead of paying 15% on 100,000, they've now only paid 15% on the 40,000. So that probably gives you roughly a $6,000 to $7,000 savings right there. And again, for my accounting friends and my tax friends out there, they're going to say, hey, there are all kind of steps in terms of the tax ladder. There are all kinds of calculations in terms of how the employment tax. We get it, but this is simply to demonstrate the power of the S corporation and how you could save taxes just by making the right entity election. And then we haven't even gotten into the cool strategies, the more advanced stuff that they could do.
Yeah. So essentially, it's only taxed on the profit, right? Like both entities are only taxed on the profit. Meaning, if let's say you flip a property and you make $100,000 and you invest 80,000 back into the business, so the net profit's only 20, you would only get taxed on the 20 for either one. It's just that the S corp has the self-employment tax on top of, or no, the LLC has the self-employment tax that the S corp have, in other words. But the S corp requires that you be on a salary, right?